We have critical, I mean, make it or break it kind of data coming out tomorrow morning for markets because of what tomorrow could signify. I'm telling you right now, if you have not watched a video of mine in a long time, this is really the video to watch, okay? You're going to learn a lot, and I'm going to give you a blueprint of what to watch out for, potentially, my thoughts around tomorrow, and what could happen. We have the jobs report. We have the unemployment rate, the secondary data that goes along with that, like productivity. You've probably heard a lot about that recently. And even a speech from Fed Jerome Powell later in the day. We'll look at the economic calendar. But for the Bulls and the Bears, really, tomorrow is critical. And even so for a stock like Tesla, that's down over 44% from all-time highs. I've had a lot of people recently suggest that now is the time to go all in on Tesla. And again, anytime you bought Tesla when the stock was down 40% from all-time highs, you have made a lot of money, okay? And I don't think this time will be any different, okay, longer term. So if you're longer term focused, buy the hell out of Tesla right now. If you want to try to get the best price possible, tomorrow's really going to be critical for that. Because tomorrow could set the markets up for a lot more potential downside or confirm that the growth scare was really just a growth scare. And typically, growth scares are 5 to 10% corrections. S&P fell about 7% from all-time highs. That would be pretty much in line with expectations, okay, for a typical growth scare. And again, the question is with Tesla, is the stock going to fall further in the short to medium term? Or is the stock going to be back above $300 in the shorter term future? So we have a lot to get into here in this video. I'll start with this, okay? And I think this is something you critically need to know. It's called a tail risk event. Now, if I lost you guys there, I promise you, you need to know this. Not just for tomorrow, not just for, the hell of it, but this is critically important. And it will explain a lot of, probably some things you've been kind of confused about in markets. So essentially, a tail risk event is when you're thinking of a bell curve, right? The middle, where the bell curve's the highest, is where everyone is expecting, right? That is your expectations, where the most people are expecting the same thing, right? In the middle. But once you get out to the tails of the curves, whether it's positive or negative, that's what moves markets. Meeting expectations in markets normally doesn't move markets. So that's why it pays to be a contrarian a lot of the time. When everyone is super bullish and they're all expecting, really good things, sometimes it pays to be a contrarian and say, no, maybe it's not going to be as bullish as consensus believes. Same is true. I think it's easier to kind of point out during corrections, right? When people are super fearful and they're all screaming from the rooftops that this is the end of the bull market, blah, blah, blah. We've seen this time and time and again. And you go out and buy that, normally you do well. It's because the middle of the bell curve starts to move, okay? It's not in one spot, right? It moves along the x-axis, essentially. So let me just read you Grok's definition of a tail risk event. And this is going to make a lot of sense to you. Grok 3 says, a tail risk event in economics refers to a rare, extreme occurrence that lies in the tails of a probability distribution, far from the central, more common outcomes. These events are typically characterized by their low likelihood but high potential impact, often leading to a significant disruption in markets, economies, or financial systems. The term comes from statistics, where the tails represent the extreme ends of a bell curve. Economists and investors care about tail risk because standard models, like those assuming normal distributions, like normal outcomes, often underestimate their probability or impact. To manage them, strategies like tail risk hedging are used. Think of it as insurance against the improbable, such as buying options to protect a portfolio from a sudden market plunge. These events are tough to predict precisely because they're outliers, but their fingerprints are often found in fat-tailed distributions, where extremes are more likely than a normal bell curve suggests. Does that clarify it, or you want me to dig deeper on my part? I love Grok 3, by the way. So essentially, the issue I see right now, and why I'm sharing this with you and hopefully teaching you something, is when you're thinking about the bell curve of distributions of possible outcomes for our markets this year, I still see, unfortunately, the outcome of a deeper slowdown, recession, as higher than the markets. Okay, so if I'm going to sit here and say the odds of a recession could be 50% this year, coin toss or so. But right now, I would say the markets, even though you're down 7% from all-time highs, or at least you were at the lows, you ended up closing today down roughly 6.63% from all-time highs. You're not pricing in virtually any recession risk. Now, clearly, you don't go into a recession overnight. That risk starts to build. And the bell curve, if you will, the distribution of possible outcomes, essentially think of it like the most priced in idea for markets. Right now, it's like 2% GDP this year, maybe 1.5% GDP this year, earnings coming in positive 10, 12% this year, the Fed cutting rates twice. That's the middle of the bell curve right now. Tomorrow morning could shift the bell curve, potentially to the negative side. That is why this is so critical, because you could change expectations with tomorrow's jobs report, unemployment rate. And even though we've gotten bad retail sales, bad personal spending, bad ISM manufacturing, not the greatest ISM services data, challenger job cuts today. Yeah, if you did not see this, I don't think I've seen a more recessionary data point like in a very long time. Okay, this thing hit 172,000 today. It was expected at 56,000. This is like what you see during deep recessions. You have never seen this kind of number besides recessions. Ever. Never happened before. Okay? Only during recessions. At a time in which the Atlanta Fed GDP Now tracker, yes, I know it's inventories, it's exports, it's the balance of trade, is tracking down negative 2.4%. I think the bell curve could shift tomorrow. We haven't gotten a non-farm payrolls. We haven't gotten a new unemployment rate since the growth scare has started. And for whatever reason or another, Wall Street, they say, yep, economy is 73% people spending money. Personal spending is lower. Yeah, who cares? Retail sales is lower. Who cares? Okay, that's kind of what they say. They kind of shrug off these smaller data points. But tomorrow is the big data point for markets. And it can shift the bell curve if it is significantly better or worse than expected. Now, this could shift the bell curve positive as well. I just think the bar is probably a lot higher for that because, again, consensus like 1.5% GDP, unemployment stays roughly where it is already. Like, to see the unemployment rate fall further from here, that's not very likely, in my opinion. To see a 300,000 jobs report tomorrow, probably not very likely, given the other data that we have. With that said, non-farm payrolls are expected at about 160,000 jobs. Last month was 143,000 jobs. Like, we are still expecting a pretty strong jobs report tomorrow. The unemployment rate is expected to hold steady at 4%. I mean, we could come in really low tomorrow. Like, if there was a jobs report in which we were going to get a negative number, it could be this one. Okay, and imagine the average kind of projection for markets if we did get a negative non-farm payrolls tomorrow, or something that's like 30, 40, 50,000 job ads. Okay, people as a consensus might go from 1.5%, 2% GDP down to 1% GDP, right? They might go down, raise recession forecast. The bears are going to come out like crazy tomorrow if we do get a bad jobs report like that. That's not good. Okay, for the bell curve standpoint, for those tail risk events. And again, for markets being down 6%, you're not pricing in recession risk. I mean, during 2022, markets were down 27% on the S&P, and we never had a recession. But you priced in like 80% of a recession, I would say. Okay, so given we've had 2 really good years, how far would we need to fall to price in a recession? I don't know. And I'm not suggesting we're going to price in a recession tomorrow, but I think the average view of markets, in other words, can move a lot based on tomorrow's data. Okay, mix the growth scare that we've had recently with potentially a really bad jobs report. Yeah, that's not going to be good. Okay, and one of the reasons why I think the jobs report will be bad tomorrow is government payrolls. Okay, the Challenger job cuts today showed it pretty clearly. I mean, it says here, quote, with the impact of the Department of Government Efficiency, or DOGE actions, as well as canceled government contracts, fear of trade wars and bankruptcies, job cuts soared in February. The government led all sectors in job cuts in February at over 62,000, followed by retail at about 39,000 and tech at 14,000. So far this year, employers have announced 221,000 job cuts, the highest year-to-date total since, get this, 2009. We're only expecting 20,000, a negative 20,000 number for government payrolls. This could come in 80,000 pretty easily. I mean, Challenger job cuts is saying that, you're going to come in probably around 60,000, but, I think it could be more than that. And I don't think the private sector did a whole lot of hiring in February either. Okay, the last thing you want to do with policy uncertainty, tariff uncertainty, is go out and hire a bunch of employees. Like, if you are a business owner right now, you don't even know what next year's tax rate is going to be if the Trump tax cuts do not get passed again, right? There's so much uncertainty. The last thing you want to do is do anything dramatic, okay? So you're seeing this reflected in a lot of data, but we have not seen this reflected in the non-farm payrolls yet, and that is the data that Wall Street really cares about. So yeah, I'm actually pretty concerned from that perspective about tomorrow morning. Okay, now you will get smaller secondary data points like average hourly earnings, month over month, year over year, participation rate. That can actually be very important. Now tomorrow you will also get Fed Bowman that speaks at 10:15 in the morning. 10:45 in the morning, Fed Williams will speak. 12:20 p.m. tomorrow, so around noon, you will get Fed Kugler, and then at 12:30, you'll get Fed Jerome Powell. Okay, right after the non-farm payrolls report. If that number is really good or really bad, that's what we want to hear from the Fed. If it changes kind of how they're thinking about policy right now, and I mean, here's the kind of scary part as well. If we do get like a negative non-farm payrolls number, negative 10, 20,000, something like that, it wouldn't be too crazy in my opinion. If it's any more than that, like, oh yeah, all bets are off the table for this market. I don't think it's going to be like negative 100,000 or anything like that. Could you be slightly negative or come in, I'm thinking between negative 20,000 to 40,000 is where I'm leaning towards the jobs report. Okay, I don't think it's going to look good at all. If the Fed comes out and they say, well, one data report doesn't make a trend, oh, Wall Street's going to lose their mind, okay? Because everyone thinks on Wall Street, hedge fund managers, literally everyone thinks, if we start getting a really bad jobs report, the Fed's going to get bullish, going to get dovish. If that does not happen, if the Fed shrugs it off, hello policy error and recession. Or at least recession odds rising. And again, I don't know if we're going to have a recession this year, but could the government turning off the spigot of free money stimulus, Doge cutting employee, workforces, tariffs, and uncertainty overall out of Washington slowing down confidence in consumers and slowing down confidence in business leaders to invest and put capital to work, could that all together be a catalyst to push us into a recession? Possibly. That's also something I think is on the, again, left side of the bell curve, a tail risk event that potentially Wall Street is not really thinking about, which tomorrow's jobs report could force them to start thinking about. And again, part of the risk I see with markets tomorrow is if we do get a good jobs report, like 160,000, 200,000, something like that, it's not really going to move expectations higher, okay? You're all, as a collective, right? A good jobs report tomorrow is not going to make people say, hey, maybe we could get 2.5% GDP this year. Or maybe the unemployment rate falls further, or some positive tail risk event. It's not going to move the needle for that, but it could be very impactful for the left side of the bell curve, the negative potential tail risk event. Now, Canada's finance minister says Canada will delay second wave of tariffs on 125 billion of U.S. products until April 2nd. So, I guess that's good, but it really doesn't change the fact that tariffs are coming. Fed Waller says not all tariffs are passed through. He says that Fed policy is still restrictive, and he says the Fed can cut rates for positive or negative reasons, which I know that's going to sound confusing, but like a positive reason would be inflation coming down, negative reason would be like the economy going in the poop chute. Fed Waller says he is seeing some signs of softer data. And look at this, Fed Waller says we have to respond to hard data, which hard data would be CPI reports, would be non-farm payroll reports, unemployment rates, things like that. And tomorrow, again, is the first real set of hard data that we will get on the economy since the growth scare started. I guess retail sales, personal spending was also hard data, but not enough for the Fed to get too dramatic about. Fed Waller says, I'm waiting to see if weakness in soft data shows up in broader statistics. Fed Waller said today, I don't see a case for a March rate cut. But he says, I could see rate cuts after the March Fed meeting. Now, why he's saying this is because he doesn't want to spook markets, okay? If he comes out and says, yeah, guys, it's March 6th, and I could see the Fed cutting rates in March, like 2 weeks from now, markets are not exactly going to love that, right? That would be the definition of the Fed cutting for the wrong reason. The odds of a March 19th cut right now are at 10%. The Fed's going to do whatever's priced in by the markets. They always do, okay? He said this today because there's a 44% chance of a Fed rate cut May 7th. Okay, you're almost pricing in the Fed to cut rates May 7th. But you are not even close to pricing in the Fed cutting rates March 19th. But if the data does come in really soft tomorrow, that could definitely sway the odds towards a cut March 19th. Fed Waller says, if February data comes in good, I will feel better about inflation. He also says a median of 2 cuts this year remains reasonable. And Canada says they will not react to Trump's latest move on tariffs until officials have studied the executive order. Fed Waller says 80 to 100,000 is likely break even for the jobs market. Fed Waller says job market conditions more closely resemble pre-pandemic times. Now, I will tell you, the S&P has fallen a lot quickly, and you're sitting right at about that 200-day moving average. So, I mean, it's not only just critical data because it'll validate the growth scare or not and really shift the bell curve, as we discussed earlier. The average kind of probability or expectation for this year. That's what shifting the bell curve is. Maybe from 1.5% to 1% GDP, or to less than 1% GDP, or for a weaker labor market this year, right? Getting closer to a larger slowdown, essentially. Well, you're also sitting at this 200-day moving average. Okay, so normally markets bounce at about this 200-day moving average. Not always, a lot of the time. We have not been at the 200-day moving average really since November of 2023. So if we don't bounce here tomorrow, it's going to get ugly. If we do, then it could be good in the short term. Now, I do think it's going to be a lot of chop. I don't think we're going back to all-time highs anytime soon. I think you're going to chop upwards, maybe back to 590, come back down, hit a lower low, go up again, hit a new lower low. That's the kind of price action I'm expecting out of markets this year. You may end the year positive, but I think it's going to be a lot of chop. Now, I think specifically for Tesla, obviously, the same thing kind of applies. Now, it's interesting because I think a lot of your higher momentum stocks have kind of started to price in some of that recession risk. Okay, kind of like what we had in 2021, where the biggest, highest momentum stocks sold off first. Okay, that is it feels reminiscent of the beginning of 2021's momentum implosion. Okay, markets didn't fall all at once. I mean, momentum peaked out in like July of 2021. And at that point, we had continued to fall until we hit a new all-time high in markets in January of 2022. And then we had the bad year in 2022. And, Tesla's not like a super risky company, right? I think Tesla has very low risk, a very low risk profile long term, but the stock just has a high beta. It is a momentum stock, whether we like that or not, for better or for worse. Sometimes that's great, sometimes that's not so great. And the fall in Tesla, I think is foreshadowing some of those recession concerns that we have in markets. But again, if we get a good jobs report tomorrow, Tesla should outperform the broader markets by a lot. And I wouldn't be surprised if Tesla could rally 5, 7, maybe 10% tomorrow if we did get a good jobs report. A 10% rally could put the stock back to about 290. That's not off the table in my opinions. Now, again, is this the time to go all in on Tesla? I think long term, yeah. If you have a long-term perspective and you don't care if the stock falls any further, then go for it. I've been slowly buying Tesla ever since the stock was at about 290. Okay, so I've been buying more and more almost every day. 3 shares here, 5 shares there, 10 shares here. And that's what I plan on doing. Now, unfortunately, I think the bell curve is going to shift further into more of a negative outlook. Okay, I don't think the average expectation for growth and for the economy this year is correct. I think it's going to be a lot lower than that. Could be close to recession, if not in recession, right? So in that dynamic, has Tesla priced in enough of that recession risk? Maybe. It's very well possible, but I think you could price in more of that. If we really started to get some kind of fear in markets, you could price in more of that recession risk. I talked about this in the previous video, but I mean, the VIX is something that I like to look at here. You've been rising, but you're not fearful yet, okay? You're not panicky yet. Today, the VIX opened at 2260 and closed today at 2487. The VIX is just rising, right? It's not skyrocketing. So from that perspective, normally you need to see a panic moment before you get a bottom in corrections. That could be tomorrow if the jobs report is bad, or again, that could set us up in a new lower range. I do not know, but I do think it is possible that Tesla could fall further. At the same time, I think you are due for a short-term rally. Unfortunately, I think it will only be a short-term rally for now. Once you get the robotaxi coming out, Optimus, coming out later this year, markets hopefully stabilize, tariff issues go away, we'll see where growth is then in the labor market, then I think you get a larger rally in the second half of this year. But first half of this year, with all the uncertainty, it is going to be volatile. And I wouldn't want to put all of my money into Tesla at one price, right? I think I want to scale into Tesla here as, you know, the stock is down a lot, but I'm not ignorant to the fact that we're basically at the same level that we were at right before the election, right? Right before the election, October 2024-ish, September, right? You were at these levels. I mean, roughly where we are now was the high in July of 2024. The high, you know, October 1st of 2024. That, to me, doesn't feel like that long ago. Could you fall further? Sure. You know, could you get down to 200? I mean, that would be a really big buying opportunity. He says, no, I don't know if you guys can see him. He's shaking his head. No. That would be a big buying opportunity to go a lot more, you know, heavy. But I want to be buying at these prices because you never know. You never know what's going to happen. Maybe things get better all at once. And the last thing you want to do is kick yourself because Tesla's now a $400 stock again. And you could have bought it $250, $260, right? So it's the risk management that I think people should think about right now when they're evaluating really markets broadly and independent stocks like Tesla. And honestly, for Tesla's risk profile being low, in my opinion, like what are the odds that Tesla fails? You know, they're very low. That's what I think about when I think about a risk profile. What are the odds of bankruptcy? Just get down to the root of it. What are the odds of bankruptcy? Or what are the odds that this business, you know, flops? Very, very low, if not damn near impossible at this point, right? Even with all the shit that's going on with Elon, it's almost impossible, right? I can't think of another stock like that is down 40%. You could say Palantir, but even Palantir has a pretty extreme valuation, even relative to Tesla. Like if you think Tesla's valuation's crazy, look at Palantir. It's trading for like 150 times sales. It was trading for like 200 times sales. Tesla's trading for a lot lower than that. I believe 40 times sales, something like that. So, you know, from that perspective, Tesla's kind of a rare diamond right now in markets. So let me know what you guys think about this down below in the comment section. Ladies and gentlemen, have a fantastic rest of your day, and I will see you in the next one.